I remember being in the back of a plane. I'm flying back from Houston, and it had already exceeded my prior price target. And I finally said, you know what? I'm just going to do what that salesperson asked for. I'm going to tell them what I think it can do. And so I ran the numbers again. I said, I think it got 400. So I went out the next morning, and I will point out that I think one of the reasons that got so much coverage was the fact that it was $400 because of that extra zero, and because it was so controversial to begin with. It was like throwing a drum of gasoline on a bonfire, and everything went crazy. Fortunately, it did hit 400, and then I think went to 580 in that stock split. So I was lucky there, but I didn't expect it to happen in 2 or 3 weeks. I thought it would take at least a year.
Welcome to the Internet History Podcast. I'm your host, as always, Brian McCullough. In many ways, he was the face of Wall Street during the dot-com era. He made that famous $400 call on Amazon stock, and he was the founder of Business Insider. Today, we're going to talk to the great Henry Blodget. Henry Blodget, thanks for coming on to talk to us today.
Thank you for having me.
You grew up here in the city, right?
I did indeed. My whole life, except for 2 years.
Your father was a banker on Wall Street?
He was indeed. Yep. Wall Street in Midtown for Citibank, or what became Citibank.
But when you went to college, you majored in history. I'm curious, given your career that we're going to go into, is there something about like the pedagogy of like history and the training of history that helped you like analyze companies, identify narratives and cycles and things like that?
I think there's something in the education of learning to be analytical and read and talk to people and figure out what's going on that's very helpful. I was always interested in financial history. In fact, in my family, the 1929 crash and the Depression were kind of legendary because a distant ancestor of mine had made a fortune in the 1920s and then lost it all in the crash. And let this be a lesson to you. So forth. So it always had that. But I think history was useful generally. Certainly economics would have been useful too, and other things would have been useful too, but it served me well. And I really didn't get interested in business and finance until the second half of my 20s. So before that, I was writing and being a journalist and teaching.
You spent time teaching in Japan. Is that the couple years that you were in New York City?
Yes, 1 year in Japan and a couple of years in San Francisco.
I think you were going to write a book about teaching in Japan. Was this in the 80s?
Yeah, this was the early 90s. I did write a book about it. And of course, just as I was finishing it up, a slew of other books that were very similar to it came out, and they were all way better than it. So ultimately, it went into a drawer. But it was a good exercise that set me up for a lot of what I did.
So then when you come back, you do get into media, like you're a fact checker, proofreader. I think you're at Harper's. But then you get on CNN's business desk. What drew you to journalism to start your career?
I was always interested in journalism. That was one of the paths for me when I got out of school. I thought teaching might be another. And after I finished the book, said, okay, time for a real job. Started looking at journalism jobs, and actually started as a reporter on a small newspaper in Massachusetts. Then came to New York and was freelancing, as you said. And ultimately, I realized the freelance lifestyle just wasn't going to work for me. I didn't have the tolerance for it. It was just so difficult to make a living. And so I was looking for a staff job. I'd gotten interested in television, which seemed very exciting, and went to CNN. And ultimately, CNN was terrific. I think it was only 9 years after it had launched at that point. So it was still sort of a startup. But that route also looked like a long route that was far from what I really wanted to be doing. And I'd grown up around finance. As I said, my father was in it, knew a lot of people in it. Had sort of run the other way after school because it just seemed like hey, the world doesn't need any more bankers or whatever. But in my late 20s, I really got interested in it and ultimately joined a training program.
Right. Explain that to me. So there's training programs. I think you were at Prudential first and then like Oppenheimer. So they train you to be an analyst. Like, what does that mean or look like?
Yeah, it's extraordinary. I mean, this is one of the things that I didn't appreciate at all when I was in school and shortly thereafter is a lot of these big companies, it's not just Wall Street, but a lot of major corporations, they have extensive training programs for people that they hire. And so I effectively got an MBA over many, many months of sitting in a class with a lot of other smart people and having actual professors from business school teaching us and so forth. And then they release you into the investment bank and you get various assignments. My first assignment was in private equity, actually, a group that focused on that. And then fortunately for me, because it made a huge difference in my career, I then started to get interested in technology. We were starting to see some of the first internet business plans. When you get the browser first, you suddenly have a big leg up on a lot of people around. It seemed very exciting. So I switched to technology and did that for a year or so. And then I switched into research, which was actually a much better fit for me with the journalism background. And I was used to working on my own rather than in sort of a military hierarchy. And so that was a great fit. And that's when I switched to Oppenheimer, as you said.
Okay, so let me poke at that a little bit because other folks that I've talked to, I like to say I've heard multiple stories that like in the early to mid 90s, if you're in your 20s, if you're a kid that knows how to use the internet, you get pulled into like the C-suite and like explain this to us, or like it launches people's career just because they're there. The internet is happening. We need someone that knows what's going on here. Like, was part of that what you experienced in the sense that, hey, there's these new companies coming out. Can we get the kid on the desk that maybe knows what the heck is going on over here?
That was a huge part of it. And not to give career advice, but one of the best things you can do if you want to have a lot of exciting opportunities appear in front of you is effectively join something early, because you will become an expert in it quickly relative to everybody else. There would be enormous opportunity created. And in my case, what happened is literally within the space of 6 months to a year, 30 firms on Wall Street all decided, hey, we need an internet analyst. And all those chairs were empty, and sometimes software analysts were taking them over, but sometimes it was new folks. And I was lucky enough to be able to have one of those jobs relatively early and to learn as the industry grew. And one of the other things that is an advantage, and I think you see this in AI now, which is another similar boom in terms of how many people are getting swept up into it, is if you have not had 20 years of market history and lived through a lot of cycles and gotten burned, you go in with a very open mind that, hey, this might be different and this technology might actually change the world, which the internet ultimately did. But you go into it, and I think a little bit more open-minded to a lot of the companies that were, especially in those days, really starting off in the internet. And so for many years, that really helped me because I could look at the industry fresh and see how fast these companies were growing and the amazing opportunities that they had in front of them and what did make them different from a lot of other companies. And I didn't come at it with the framework that I came at things later, like crypto, which is, hey, we've seen this before. It's going to grow for a while. It'll be a bubble and it'll burst. And unfortunately, that attitude leads you to missing out on lots of very exciting things. Unfortunately, I didn't miss it in the internet.
Okay, for context, I want to look at what an analyst is looking at for companies that are internet companies, internet startups in the mid 90s. Like, what's the toolkit? How do you look at value at businesses, again, that are like 6 months old, have no profits, but, lots of potential because the potential of the internet is like a green field of infinite, right? So, like, how did you and other analysts like you, like, how did you value stuff and how did you pick winners and losers versus when everybody's just basically kind of winging it and it's all brand new?
Yeah, it's all brand new, but you do right from the get-go, you had some metrics that you could look at for how fast the internet was growing. And these metrics are metrics that people like Jeff Bezos looked at when he was an investment banker or working at a hedge fund and said, whoa, look at this growth. What can I do to get in front of that? And so that's what we were all doing. And as different waves of companies came out, you would have different theories about how big they could get, how big could the internet get, how much advertising could be on the internet, how big could e-commerce get. You always, with a new industry, you're going to have an enormously wide range of reasonable estimates as to what that can be. And depending on where your estimates shake out, you're going to have an enormous range of potential fair values for companies. And we all knew at the time that every time a new industry is born, thousands of startups are started. Most of them are going to fail. But if the opportunity is real, a few of them are going to go on and build really big businesses. And that's what a lot of us were saying. It's certainly my investment philosophy in those years was based on that, which is, yeah, most of these guys are going to fail. We don't know what's going to work yet. But when you combine what seems to be a great opportunity with really strong fundamental growth, not a hallucination, great management team, great backers, you're probably giving yourself a decent chance.
Well, I'll give you a metric that we don't use anymore, but eyeballs was a metric that was popular back then, but which is really traffic growth. But then I'm curious also, like things like CAC or lifetime value, again, because, like the internet, even by 2000, I don't think had reached 1 billion users. Like when you're trying to analyze, again, the potential is every human being on the planet, like how do you value things like unit economics or market if the market feels like it's infinite and no one really knows where the parameters are?
You have to make assumptions and estimates. And I would say that one thing that differentiates the range of people that are doing that is there can be estimates that are well considered. There's a lot behind them. They're very thoughtful. That usually might get you to a better sense of what a company could be worth than something where it's just a sawed-off shotgun and you have really no idea. And to your point, yes, nobody knew how big the internet would be, and nobody knew how much shopping would migrate to the internet. But you did relatively early have the sense this is a big opportunity. There's a huge amount of money going on. The growth rate of people downloading Netscape's browser, for example, and the growth rate of websites and the growth rate of Yahoo, which was one of the first portals. You look at that and you say, okay, something real is here. And also for me, what really changed it was when I got the browser. It was Netscape browser, incredibly exciting. You load it up, you see what's possible. You're immediately in a much better position than somebody who's just sort of reading about the internet third hand. I mean, you could really see it. You can see what it does that wasn't there before. And so you can start to see the possibilities. But again, nobody knows. Venture capitalists are the first, and they're starting with people who there's nothing. It's just an idea. And you're making an adjustment about a person, and you're saying, well, maybe the idea is not perfect, but then they'll pivot and they'll figure out the idea. Or am I going to back them? Am I going to not? And I will say, to your point about eyeballs, especially in hindsight, it's extremely easy to ridicule everything that is happening. What I would respectfully suggest, having now lived through several of these, is this is the only way an industry is going to develop. And everybody's actually acting pretty rationally. People looked at the internet the same way they're looking at AI now. They look at the internet and say, wow, that looks like a big opportunity. I have an idea. Is it right? I don't know, and I'm not going to know until I try. So you try it. Most of them fail, but some of them work. And the really smart people will iterate. They'll find the right ideas. All the good capital will come in after that. So this idea that it's just such a waste, everyone was so stupid, it's just not actually the way it happens in real time. Yes, a lot of dollars are wasted, but that's the same as in the old days. You would have R&D done in a corporate lab. Almost all the experiments would fail. All that money would be wasted, if you want to look at it that way. But they would figure out a couple things that would work, and they'd be off to the races. And the quote that everybody loves is Silicon Valley, which is totally fair, is Thomas Edison saying when he said, I've tried all these dumb ideas. He said, I have not failed. I have tried 10,000 things that didn't work. And now I know that, and now I'm going to have the thing that does work. And there's just no other way to build industries. So especially as I see AI going again, and there's all this stuff about it's an AI bubble and it's going to burst. That is probably true, but there is no other way, in my opinion, to develop the industry, and some great things will come out of it.
It's funny how we can't. It's this conversation. We keep bringing up AI every time. We could do it every single time, but let me do another historical context here. companies like 98, especially 99, there's IPOs like every day, multiple IPOs. And these are companies that are maybe 18 months old, right? But also the context being different is like Amazon went public at a $500 million valuation, and was a couple years old. Nowadays, nobody goes public until they're a unicorn, right? And they stay private for almost a decade. What was different about that time, the incentive structure that made it so that there were 300 IPOs or whatever crazy thing it was in 1999? Companies are 6 months old, immediately go public.
In those days, in part because of what happened after the internet, when so many IPO investors got burned, when such a huge swath of these companies failed, there were really barriers raised on IPOs that made them much more expensive. Suddenly it cost $5 million to be a public company. You had to be incredibly funded. The lawsuits that came in afterwards made the litigation expense very high. So companies just started to wait a lot longer before they went public. And the private markets really developed so that companies can now easily fund themselves through many, many, many rounds, and they can get huge before they finally go to the public market. And a lot of management teams, they don't want to deal with the public market. It's annoying. You're on CNBC. People are talking about you all day. People are gambling on your stock, talking about how stupid you are. And the stock goes up and all the employers are like, "Whoa, we're smart today." And then it goes down and everyone say, "What do we do wrong?" When it has nothing to do with you. So a lot of companies, I think today, are just deciding like, we don't need that. We'll just stick with the private capital. We'll operate in the obscurity of the private market. And then eventually, maybe we'll go public many, many years later. But that's very much changed. In the internet era in 1990 or 1990s, the idea was public market investors wanted access to early stage. They wanted to be able to make bets on companies like Amazon when they were small, instead of, as with Facebook and many other companies, allowing all of those early returns to go to private market investors and then public market investors only to get to buy in later when the companies are already huge. You can still do well. Facebook and Google and many others have done extraordinarily well after the IPOs, but you do miss out on a lot of years where people are making an awful lot of money in the private markets.
Do you think that was a mistake? I think it was FinReg is the regulation that comes in. Do you think that was a mistake that now it's harder for the general public to participate in those earlier stages of companies?
I think it totally depends on how you look at it. If you think the job of regulators is to protect human beings from making mistakes that they want to make, that they do very voluntarily, participate in IPOs, okay, then have higher regulations. If you think you want regulators to just simply police fraud and crime, but let people do what they want to do, then the higher regulations are probably negative for public market investors. And I would say there's a good analogy in sports gambling, except that sports gambling, unlike the stock market, is much more of a loser's game. You are almost guaranteed to lose in sports gambling if you play, because of the fees and the intelligence of folks on the other side and the big companies that control it. In the stock market, at least, stocks generally do go up. So if you don't hurt yourself by making an enormous number of mistakes, you can probably do okay. Less well than if you were just buying an index fund in most cases, but you can probably do okay. So it totally depends on what you want to do as a society. Personally, I think that when you have a new industry and everybody understands that new companies in the new industry are extremely speculative, and if you buy one, you might lose all of your money, I think at that point, you can open that up to investors and, hey, say, well, you're clear about the risks, go in. But a lot of people disagree. And we definitely, after what happened after the internet, I think everything is tightened up. And now the idea is, no, we must prevent individuals from making mistakes.
So as you mentioned, you're on CNBC constantly in the late 90s. It's a different world today. We would call you an influencer now, or, there's people whose entire investing careers are built on social media, via memes, podcasts, all this stuff. Were you surprised to become famous doing what 10 years previously was like a behind the scenes job?
I was shocked. And it all happened in a morning for me. And I had been sort of toiling away for a couple of years in complete obscurity. Most analysts, what you're doing is you're writing reports and you're speaking to the firm's sales force and you're going all around the world talking to big institutional clients, but there are only a couple hundred of those. You're not talking to the public. Yeah, you'd go on TV once in a while or be on analyst calls, but it was not a glamorous job, not particularly highly visible. And while I was doing that, I wasn't watching it, but while I was doing that, what was happening is you had early internet companies that were sort of democratizing trading. People were making so much money on tech companies that a lot of people really got drawn into it. It became a thing to do. And so everybody was getting into it. And then, yes, I made one particular high profile prediction that for whatever reason, like plucked the chords of the zeitgeist and was very much talked about, shall we say. Suddenly I was well known.
Well, this is what I was going to say. We would call that going viral now. And we're referring to your famous call with Amazon. Amazon's going to get hit $400. I think you make it in late 1998. Can you walk us through that? Like, again, I feel like now people, with the metabolism of the internet and meme culture and things like that, that would have been a calculated thing. This is the call that I'm going to make my career. I feel like at the time that's not what you would do. So what were you looking at in that Amazon call that was like, you know what, I just got to make this call?
Amazon had been public for, I think, a little more than a year at that point. It had always been incredibly controversial because when it went public, you had a huge array of very experienced investors look at it, say, this is absurd. This is a bookstore. Bookstores trade for these rock bottom multiples. It's an incredibly cutthroat business. They can't make any money. This thing is losing tons of money. The internet's a fad. This valuation is a joke. On the other side, you had Silicon Valley venture capitalists and tech investors who were saying, whoa, look at this growth rate. Look at how big this company could be. Look at the fact that they started in books, which is a great category for a lot of reasons, but they're going to go into music and they're going to go into toys and they're going to all these other things. And they're a super smart management team. Companies run exceptionally well. They'll probably spot a lot of other things to go into over time. So we think this company can get huge. That was a big fight in the markets for at least a year. And then when I started to pick up coverage, the stock had already done very well. People were astonished. It was getting trashed all day long on chat boards and people were saying how stupid it was. I came out when I picked up coverage and said, no, you know what? The optimists are right. Like, this is a company that's worth making a bet on. There's a lot more upside that's not in the stock. Go. But I was a new analyst. I said it pretty quietly. Oppenheimer had a conservative sales force. They're like, oh yeah, Amazon. Okay, we're just going to watch this thing for a little while. In relatively short order, the stock went from something like 90, where I rolled out on it, to 200. I had been nudging my price target up as it went up. And I finally had one of the folks on the sales force say, Henry, you keep coming out here and telling us how great Amazon is, and you put a price target on it that's 15% above the current price. Like, why would we buy it if that's the only upside we can get? Why don't you go off and do your numbers and come back and tell us what you really think it can do? And I actually had done that in my first report. I'd said basically, hey, you're right. There's a wide range of possibilities for this company. It could be worth anything from $2 a share to $400 a share. I'm going to start with, I don't know, whatever, my 120 price target. So I went back, I redid the numbers. The company had actually done even better than I thought it could over the time. I remember being in the back of a plane. I'm flying back from Houston, and it had already exceeded my prior price target. And I finally said, you know what? I'm just going to do what that salesperson asked for. I'm going to tell them what I think it can do. And so I ran the numbers again. I said, I think it got 400. So I went out the next morning. And I will point out that I think one of the reasons that got so much coverage was the fact that it was $400. Most companies in those days were splitting their stocks very frequently. So shares were usually between $10 and $50, and then the company would split its stock. Now they don't. Now stock can go up to big numbers, but in those days, $400 was like a big number. What I did actually was no different than putting a $40 price target on a $22 stock. But because of that extra zero, and because it was so controversial to begin with, it was like throwing a drum of gasoline on a bonfire. And everything went crazy. Fortunately, it did hit 400, and then I think went to 580 in that stock split. So I was lucky there, but I didn't expect it to happen in 2 or 3 weeks. I thought it would take at least a year.
Hey everybody, this is Brian cutting in here real quick. If you like the deep dives into tech history that I do on this show, you should know about my day jobs. First of all, I'm the host of the Tech Brew Ride Home podcast, part of the Morning Brew family. Every day, in 15 minutes on that show, I tell you what happened that day in the world of tech. For almost a decade, it's like I'm telling you the tech history that is happening in real time. I'd love you to check it out because that show allows me to do this show. Search Tech Brew Ride Home in your podcast app of choice. But also, I have a rolling fund, the Ride Home Fund. We invest in early stage startups, have made dozens and dozens of investments over the years. So if you're an accredited investor, you can invest alongside me in the companies making the tech history of the future. You can find out more and sign up to invest alongside me at ridehomefund.com. Yeah, I think that compressed time period is also what made it so famous at the time, is that, oh, this is really, the phrase at the time was internet time. Things are happening on internet time. Paint the mood. I've not really talked to a lot of folks from the Wall Street angle about how Wall Street thought of these newfangled tech companies in the late 90s. Like, what do they think of this explosion of startups? It's a different culture. We're used to 30 years on the culture of startups and how technology is 30% of the market and the economy and stuff like that. But what was Wall Street's perspective on these tiny companies just coming out of the woodwork like cockroaches?
I think, again, a wide range. Investors who had invested in tech startups and small IPOs for a long time, very used to it, very used to making these projections with relatively little to go on and making assumptions about market size and management teams, so forth. Most investors thought it was ridiculous, thought it was the latest bubble. We've had these crazes before. We had them with color TVs in the 1960s, had it with radio and planes and cars in the 1920s, canals, everything. Like, we've seen this cycle again and again and again. So I think a lot of investors thought that's what it was. But one of the big differences between the internet and, say, biotech, where everything is incredibly speculative for the first 5 to 10 years of drug testing, everybody who invests in biotech gets it. It's always a hugely binary potential outcome. Could be worth billions or zero, and you're going to better expect both because you don't know. In the general markets, much less the case. And what the internet started to do was started to affect almost every industry there was. So most investors, no matter what they covered, had to engage and develop theories about it. And retail is a very good example. Again, I spent a lot of time talking to retail analysts whose instinct was Amazon is ridiculous. Like, we've had catalog companies before. They're not worth much. Why is Amazon worth much? And so forth. So very spirited debate. But as the decade went on, and year after year after year, you had these prognostications of doom that were proved completely wrong. And investor group after investor group was left behind. If they didn't own AOL or Yahoo or Cisco, they would underperform the indexes. Gradually, more and more people got on board. And ultimately, it's when most people are on board that's when actually the early folks should start to have the alarm bells going off, because consensus is always a scary thing in one way or the other. And ultimately, by the late 90s and early 2000 in particular, we'd achieved a consensus that the internet was going to really create a lot of business value. And ultimately, that was a pretty good time to actually say, yeah, and we're going to take a break as a result of it.
We're going to take a breather. Right. Okay. Because calls like AOL Time Warner, you mentioned AOL because AOL analysts are like, if you're wrong on AOL, people stop listening to you because AOL keeps going up. But then let's use AOL Time Warner as like the lesson of, like, what do you learn about conviction and humility from its feedback loops, right? So that, okay, if you're negative, and you're wrong so many times, no one's going to listen to you. But then at some point, a stopwatch is right? So, what did you learn about that, like humility and realizing that it can't go up and to the right forever? It might go up and to the right forever on an infinite timeline, but there's going to be hiccups.
Yeah, I think AOL analysts thought at that point that given AOL's big challenge coming up, which is that they had to move from dial-up to broadband, it wasn't quite clear how they were going to do that. They had this incredibly high valuation. AOL buying Time Warner actually seemed like a pretty good move. Like it's safer. Those are a lot of cash flow in those companies and so forth. And I clearly Time Warner investors got the worst end of that deal because ultimately the Time Warner assets propped up AOL for a lot of years when they were ultimately not able to make that crossover to broadband. So, but I think if you invest in sectors like this, unless you're just blindly arrogant, you develop humility pretty quickly. And one of my bosses on Wall Street used to say, look, the job of an analyst is just an exercise in public humiliation. I mean, you are trying to predict the future. You're going to get things wrong. Get used to it. You're only valuable if you say things that are actually interesting and help people think. So don't get cautious. Actually make bold calls that help people and go out and do that. But yes, the AOL, there were signs in early 2000, right after they did that deal, that things weren't going that well, and ultimately that was the top, and that was it. But there was a lot more. At least they had a big media company like Time Warner to cushion the blow. A lot of the other internet companies didn't.
To go back to the timeline of your career, eventually Merrill Lynch hires you. You're like running all of global internet research, a big high profile job. I mean, you're maybe one of the best students of bubbles, perhaps. In the end, for specifically the dot-com bubble, the 90s, you're not wrong that these companies are going to take over and go to the moon. But is the ultimate lesson you can be right, but too soon, get the timing wrong?
Yeah, I think there are a lot of lessons. I think that the first thing is, particularly on Wall Street, time horizons can be very short. Professional investors in particular are measured by the day and week and month and certainly by the quarter. And so you actually not only have to be right about the direction of the stock, but you have to have your timing right. You can't just sit there and be wrong for 2 years about some huge thing and expect everyone is going to wait patiently and leave their money with you until you're finally proved right. What happens is money's very liquid. It just simply moves to the places that are doing well, where people think, hey, this person gets it. That person just doesn't understand the internet. Things have changed. Even Warren Buffett at the peak of the internet boom or tech boom, even he was starting to be dissed by people who were saying, oh my God, he missed tech. He's an idiot. He's like a dinosaur. Berkshire used to be great, but whatever, they've had their years. Let's go buy tech. And I remember him saying something in, I think, either early 2000 or 1999, came up at the annual meeting, like, why aren't you buying tech? And he answered cleverly, as he always does, in a very folksy way, like, yeah, we'll leave that to others. And of course, he was totally proven right on the timing side. But yes, there are a lot of lessons. One is, if you're a professional investor and you're benchmarked and a big trend like this comes along, you probably want to have some exposure to it. Two, if you're an individual, don't go anywhere near any of this unless your risk tolerance really is extreme and you're prepared to lose most of your investment. And even then, keep it diversified. Don't bet everything on a new sector because ultimately it's going to get ahead of itself. Same is totally true for AI today, by the way. At some point, there will be a big setback. Another lesson, which I say, I felt like I was right for a long time about it. And over the next couple of decades, I began to revisit it, is my recommendation in the late 90s was, hey, the internet is real. These stock prices look insane, but some of these companies are going to come through this and they're going to go on and build these amazing businesses that are extraordinarily valuable. That was true. But what I didn't realize was just how few of them were going to make it. And companies like Yahoo and AOL, I thought they were in really good shape. Cisco, really good shape. Others, all these infrastructure companies, if you don't want to like pick the applications, you can at least be reasonably confident that the pipes in the ground are going to get used and so forth. So I thought more companies would come through. A lot of them did straggle through. Even Amazon, I think it was down 96% at the peak. It looked like it was going to go out of business, but eventually came back and returned just a staggering amount, made up for all the losses in the others. But when I looked at it recently, 20 years later, 25 years later, very few companies actually went on to create a lot of value beyond their peaks. Amazon did. Very lucky that I got it. And then
eBay did.
Amazon did. eBay did, but not wildly.
Mm-hmm.
Cisco is just now, a
Mm-hmm.
quarter century later, crawling back to the top. And a lot of those infrastructure companies went to zero. I mean, they went bankrupt.
And even Microsoft had a lost decade too.
Yeah.
Yeah, right.
That's right. And so it just, it's another bubble lesson for me. And I've actually written about it very recently with AI is, hey guys, look, everybody thinks OpenAI is for sure the Amazon of AI. And so there's no price that's too high. You just got to be in there. I would say the history of the internet suggests that we should think carefully about that because, again, Yahoo and others looked like they were in position to do that, and then they blew it. And even if OpenAI is the best today, the biggest, has the best people, has the bright idea, they got to keep executing year after year after year. And that is extremely difficult to do. So at some point here, and I would say my guess is at the time of this interview, we're probably only in 1997 in AI. We've probably got another year or two to go before we really get out of hand. That's my guess. I have no idea. But boy, everybody's talking about it. I mean, do not, historians, let people tell you after the crash that we were all just stupid and nobody saw it coming, because almost everybody sees it coming. And yet OpenAI can still go out and raise tens of billions of dollars at some new fantastic valuation every 6 months and nobody bats an eye. So I think it's going to continue, but at some point there's going to be a major retrenchment. And my point only to the folks who are elbowing each other out of the way to get into OpenAI at $500 billion valuation is, maybe it's the Amazon, but maybe it's the AOL. So be careful.
Okay, after the bubble bursts, there's investigations into investment banking conflicts. You eventually settle with the SEC, accept a lifetime ban from the securities industry. 2 questions on this. First one, framing again in modern times. Like when you think back about those investigations in this era of GameStop, and retail investing basically living in an ecosystem of social media and Reddit posts and memes. How do you think of being caught up in that sort of like, well, we need some scalps to explain this bubble?
Well, it completely sucked. I mean, being subject of an investigation like that is really rough. And I have sympathy for anybody who's going through it. But I would say that one of the odd things that happened to me is after the market crashed, which I felt like an idiot because I'd missed it and so forth. I'd lost a ton of money myself. Yes, I'd been right about the general shape, but I had missed the top, could have gone out a hero, didn't, felt like an idiot. I was reading a small book by John Kenneth Galbraith, a financial historian, I think called Short History of Financial Euphoria. And it's a great book. It's 90 pages long. I would recommend it to anybody. But basically, he said, look, here are the stages that you go through. And they're all the stages we had just seen in the 1990s and we're seeing now with AI. We saw with the housing boom. We've seen with crypto. All these different, you're going to go through it. The last stage is when you have the backlash. And that is the bull market for prosecutors and lawyers and lawsuits. And often what happens is the people who were most heralded for their financial genius get in trouble. A lot of them, get sent off to jail and so forth. So I was reading this between when the market crashed, before Elliot Spitzer really arrived on the scene. And I was like, oh, my goodness. And then, yes, we had Elliot Spitzer, who I ended up voting for as governor. I actually admired a lot of what he did, but I did not admire what he did to me, which was ultimately what you just described.
The philosophical end of this is you have to reinvent yourself. You're not able to do the thing that you were very successful at that you got famous for. People have to reinvent themselves sometimes, not of their own volition. Maybe you get laid off, whatever it is, right? On a philosophical level, thinking back to that time, for people listening, what did you learn about, I have to pick myself up, I'm going to do something else, I still have value that I can bring to a career?
That was exactly what I'd hoped. I mean, I was still, what you get hit like that, or something, you go through a process like that, and it is really rough as you're coming through it. At some point you step back and you say, okay, but in my case, relatively young, healthy, I can still think. I don't have to go through what so many people go through, where there's a car accident or something that ultimately changes you physically, or you have your brain, or you get hurt. I read stories about, one of the ones that really inspired me is called The Butterfly and the Diving Bell, about a magazine editor in France who was just going home from work on a normal day and had a stroke and got something called locked-in syndrome, where all he can do is blink an eye. And I think he lived for another 6 months or so. Somehow he was able to completely get in his head, experience the world in his imagination, and just what he could see through his eyes. Tells this incredibly inspiring story. And I read others like that. And when I did, I was like, okay, let's keep this in perspective. You had a career disaster, and yeah, you have a big reputational problem, but lots that you still can do. And I had young kids. I wanted them to be proud that I just didn't get knocked off, and that was it. And so I started to try to do what I could do. And one of the things that I could do was go back to journalism, where I'd started. I remember calling a friend of mine at the New Yorker. Martha Stewart had just gotten in trouble with the SEC and indicted for lying, I think, but around a stock in what was potentially insider trading. And she was going to be tried. And so I called a friend of mine at the New Yorker and I said, do you think there's any editor anywhere in New York that would publish me, given what's going on right now? And she said, I know just the guy. And she sent me to Jacob Weisberg at Slate. They hired me to cover the trial. I went to the trial every day, which is totally fascinating, started writing about that. And of course, one of the big ironies, many years later, when Eliot Spitzer, then governor of New York, got in trouble for a prostitution scandal, he lost his job, went off into the wilderness for a little while, and then came back as a writer for Slate. So somehow life is very weird that way. It's long. Ultimately, we had lunch together, which was also interesting. And so yes, but that's why I didn't want to have that be the final exit.
You're also blogging. I think you do the Internet Outsider blog, and blogging. I mean, this leads us to Silicon Alley Insider, which becomes Business Insider. Blogging teaches a lot of people around this time that media, the cadence of media and the form of media is different. The metabolism of media is different. So take me to day zero of what becomes Business Insider, with Kevin Ryan and Dwight Merriman, and how that comes together.
Well, I started a year or two earlier with the blog, which you mentioned, Internet Outsider, is exactly that. It's that what the internet did is it took us from a world where most people would get up in the morning, they'd get their newspaper, they'd read it, maybe they'd have CNBC on while they're getting dressed. Then they would go to work, they'd toss the newspaper in the trash, and they would be fully offline and disconnected for the workday. Then maybe they'd watch the evening news. You went from that to suddenly you have this thing on your desk that is now connected to the world. And in addition to being able to do spreadsheets and word processing, you can learn what's happening. And in those days, you never had TV networks that were online. Not that anybody wanted to watch TV on their office computer anyway, because you're busy at work. It wasn't the right format for that. But newspapers for 100 years had been publishing all their stories at 11 o'clock at night. They're not reporting what's going on during the day. And the few news organizations that did, like the wire services, those were limited to big, expensive machines for Wall Street and so forth. And so suddenly there was this big opportunity for new media companies to fill that space and tell people what was going on and tell them what it meant all day long. So while they were having a break in their work, they could check in. Oh, that's happening. That's interesting. They could read a few people on it. Ultimately, that's where Internet Outsider started. I started commenting on what was happening on the news the same way I had as an analyst. People started reading it during the day. That was going on everywhere. blogging was big. And then, yeah, ultimately Kevin Ryan called me, and I'd known him from DoubleClick. He was the CEO of DoubleClick when I was covering them as an analyst. And he said, what do you think about a tech crunch for New York? By then, Mike Arrington and TechCrunch were already pretty big in Silicon Valley. Everybody was reading them, very exciting. They're very smart about technology. They're taking advantage of exactly what I just talked about, which is this big new font of information and analytics on the industry from Silicon Valley. So Kevin's idea was, hey, could we do the same thing in New York? And I said, yeah, we can. And you know what? I want to do it with you. Let's co-found it together. And we did. We had a third partner. And ultimately, one of the things that I'd been very interested in doing, having watched all the company development in the 1990s, was starting a company at some point. And it was perfect for me because I'm not sure left on my own, I would have done anything. I mean, Internet Outsider was part of a company, but I don't know that I would have raised capital or done too much with it. Kevin and Dwight had done that before several times. They knew how to do it. So they were perfect partners for me. And I became the CEO. They were both board members, we all put in a little bit of money. And ultimately, that's how we started. And we did the same thing. And to short circuit, jump right through it. The first day, it was all about New York, except for one story, which was about Apple. And we looked at the analytics and we noticed, wow, that one Apple story was read by probably 40 times as many people as all of these stories about little startups in New York. Why don't we be a tech company, not just New York? And so very quickly, we kind of pivoted and opened it up a little bit.
Well, let me ask you about the editorial formula, like speed of posting, charts, explainers, aggregation. There's other folks doing this at the same time, like Huffington Post and BuzzFeed. But how much of what your editorial formula was intentional, and how much of that was like literally trial and error, the throwing spaghetti against the wall, like you just mentioned?
I was very intentional because I had been in the blogging world for a couple of years by then. And the blogs that got big were the blogs that were publishing pretty frequently because things were happening during the day and you wanted to know what they meant. And there would usually be a group of smart, opinionated analyst types or bloviators who you'd say, oh, okay, I want to know what they think. And so there was this thriving demand for something just happened, tell me what it means. And that's what SAI started as, was, okay, we were to cover the tech business. And we had an advantage because I hired two journalists who'd been tech journalists for a long time, and I had the financial analytical advantage. So we had something that few teams had at that point. And so we were able to bring that to it. And we realized very early on, it's like, when you haven't published something for a couple of hours, especially when things are happening, it's like a radio station having dead air. The cadence was somewhere between a newspaper and talk radio. Like you have to be on the air all day long. And we figured that out. It was very exciting. You'd hope news would happen because people were very interested in that. But if news didn't happen, that's a good time to drop one of your analytical pieces, maybe raise questions. We had a very vibrant commenting community. People would come, they'd want to weigh in, we'd learn a lot from them, they would become sources. But it really goes back to what I was saying a few minutes ago, which is we were filling a gap that traditional media was not filling because very different time. It's not TV and it's not the 11 o'clock at night newspapers. And all the really good analytical stuff, like the Wall Street stuff, that's all behind paywalls. Nobody can get to it. And nobody really, those guys, as I did, very financially focused. It gets dry very fast. They're not doing fun stories. It's all just dry analysis. So there really was a great opportunity to be in the middle of that and serve this very big, passionate group of online business people who wanted to know what was going on in the online world. And we developed that. We try to serve it every day, all day long.
How did you put the newsroom together? Because I want to posit that there's like a Business Insider mafia in terms of the media in New York City that covers business, that covers tech. These are just some names like Alison Chantel, Nicholas Carlson, Peter Kafka, Steve Kovacs, Jay Yarrow, Joe Wiesenthal, like people that are media in New York City today. How did you like make that murderer's row of talent? How did you find that?
First of all, it's incredible, and they are incredible, and I'm so proud of that, and just so happy and impressed with what folks have gone on to do. And I mean, how did we do it? Listen, a small company needs the folks. You can't hire too many people. You need the people you do have to make a real contribution. And what we found again and again was it was a very difficult transition for traditional print journalists because they were used to a very different cadence. TV, why would anyone ever leave TV? There's so much money in TV, and this is so not like TV anyway. So there were relatively few people who could make the transition to that cadence of half writing, half talk radio, and have interesting things to say. And ultimately, when we started off, it really was about having interesting things to say. It's, are you a smart analyst? Can you call somebody who's smart and have them say something smart that you relay? Can you see what's important? Because there are 9,000 things you could be writing about and people only care about 4 because only 4 really matter. Can you write about those? What we found is that some people had that, like they just had that gene, even if they couldn't write a clean sentence. So you'd have to edit it very carefully or it would go up with typos, which a lot of them did in those days. A few people had it. And the ones that had it, the great news about coming into a new market like that, new opportunity, is you got a green field in front of you and you can run really fast. And so a lot of the folks you mentioned ran into that green field. They did great. They were amazing for us. They helped us build this really passionate audience who was coming back all day long. And then ultimately have gone on to other places. And there's some folks who are still at Business Insider who are doing it. But ultimately, they were the ones that helped us create this really passionate community and made it a hit.
In the interest of time, I have to light over selling eventually, Business Insider, et cetera. I want to squeeze in some, because we keep mentioning AI, some questions about the parallels that you see to this moment between even the .com or the housing bubble or whatever. You said that you think that we're maybe a couple years away from an AI bubble happening. Not investment advice, but what are the parallels you see of this AI moment, and then the key differences where it's like, well, it's not like the .com era because of X, Y, or Z?
The key parallel is there's this new thing that you do not have to be a genius to look at and say, whoa, that can potentially be huge, and it's going to affect not just a small market of tech buyers, but pretty much everyone in every industry on the planet. And it is growing extraordinarily fast. And the product, when you first try it, it's jaw-dropping. It's the same kind of response that people had to Netscape when the browser came out. You're just stunned by what it can do. And I remember the moment that I first tried OpenAI, I couldn't believe it. And so that has ignited this. In the couple of years since, three years now or so since, we have just an almost unfathomable amount of money that is being invested in this sector. Because unlike the consumer internet, these companies are just tremendous incinerators of capital and hundreds of billions of dollars. I think it's literally $400 billion this year is being invested in chips and infrastructure and so forth. All these companies are getting funded. They're all trying to outdo one another. They're all thinking, the problem with tech is it's a winner take all game. If you're not number one, you might get 5% of the market. And if you're not number 2, forget it, you're done. So they are all running as fast as they can, raising as much money as they can. We had this funny moment 2 or 3 years ago where for literally 7 seconds, people were like, whoa, AI, like the Terminator, like this could actually be a danger to humanity. Maybe we should slow down. And everyone was like, no way. And off they went. Now nobody talks about it anymore, except the CEO of Anthropic occasionally mentions it. We're not even thinking about it. We're in an arms race with China. It is to the point where, as the internet did, and as the railroad boom did, and others, it's now turbocharging the whole US economy. In fact, a scary percentage of the growth of the US economy this year, 2025, is attributable to the AI boom and the build out. So that is a parallel. The other thing that's a parallel, and it's dangerous, is that the investment has run so far ahead of the fundamentals that at some point, you're probably going to have a wicked reversal there. And what I mean by that is when you invest $400 billion, you need a pretty huge return on the revenue side. actual revenue, paying customers and profit to justify that. And unlike fiber, when you put it in the ground in the internet, some of the fiber was laid, so much of it didn't get used for decades. The good news about fiber, it doesn't deteriorate. It just sits there and eventually it gets filled. Whereas a lot of the investment in the AI bubble is going into chips that have a relatively short half-life. NVIDIA will come out with new ones. These guys will be old. So 2 to 3 years is a depreciation cycle. That means it puts even higher burden on the amount of money you have to bring in from customers. And so what a lot of smart analysts are pointing out is like the current trend is not sustainable. So question is, where are we in that? The other thing that's happened is a direct parallel. The entire venture capital world has reoriented itself around AI. That's where the action is. All companies are AI stories. Those are the ones that are getting invested in. They're getting invested in valuations that look like the internet, like penny poker. I mean, it's ridiculous. The valuations are so high. So, but one big difference, and you alluded to it earlier, we talked about it directly, is that most of this investment is being made by venture capital firms whose partners are things like pension funds and other companies that can afford to lose money. And very importantly, the astronomical cash flows of some of our tech giants like Microsoft and Amazon and Google and Facebook. So if we hit a moment where all of this collapses in on itself, how much bad stuff is going to happen? At this point, those big companies are going to get some egg on their face. They'll take a big write-off and that'll be that. It'll reset and be fine. But if over the next couple of years, it really, really speds out where you've got speculation across the economy, or you've got many, many more companies across the economy really making big AI bets. If we then get a retrenchment, that's where you're going to get a really bad snapback. But we're not there yet.
All right. 3 real quick ones because I got to get you out of here. You wrote a book called The Wall Street Self-Defense Manual or something, similar title. If you were writing a book today, a self-defense manual for the AI era investor, is there a thesis that you think would make that a book?
Yes, same thesis, which is the thesis of that book. And I'll give you the background, which is when I left Wall Street, I had never focused on how to invest as an individual investor. I was all about helping institutional investors make decisions. They're very sector focused. They have a certain amount of money to invest. They just got to figure out which stocks to put it in. Individuals, very different. I didn't know how to do it. I did a year's worth of research to try to figure out what's the smart thing to do. When I figured it out, the answer was clear. It wasn't an opinion. It was actually clear. So I figured, okay, I'll write a book about it. And the answer is, for almost all individual investors, you want to invest in low-cost, tax-efficient index funds. You want to have your money diversified between cash and stocks and bonds. Maybe you have some gold. Maybe if you're super forward-looking a few years ago, you buy some Bitcoin or whatever, but those are small pieces of your portfolio. And then you save the trading piece for just a small, only if you like it, and it's just a small percentage of your portfolio that really is like entertainment money. I mean, it's like your sports gambling money because it's fun and so forth. But the idea that individuals can year after year after year pick their own stocks and beat the market, competing against hedge funds and everybody else to do it because it's a zero-sum game. It's just ludicrous. And unfortunately it seems so easy because the stock either goes up or down. It's a 50-50 coin flip. You're going to get that right from pure luck half the time. So you very quickly feel like a genius. The other thing people don't realize, you put a streak together, you feel like a genius. The other thing people don't realize is lots of mutual funds and money managers charge a pretty big fee that comes right out of your returns. And when you're talking about a market that on average is up 10 points a year, once you take out fees and taxes and some of these wrap funds and everything else that a lot of the big firms will put around it, you may have 3 or 4 points taken off of your return. And that's if they match the market, which most, even professional investors, do not. So you look at it, basically it's index funds, well-balanced portfolio, understand your risk tolerance from a very clear-eyed perspective, by the way. What does that mean? And this is just one more aside. It means, for example, now in the stock market, you have to be very clear. Stock market could drop at least 50% and possibly 75% from where we are now and still not be historically screamingly undervalued. So it can absolutely happen. How will you feel if that happens? And what are you going to do? Because the thing you do not want to do that is devastating, that most people do, is they ride it all the way down. Then when it's down 40%, it looks like it's going to drop 70% from the peak. So they sell, and that's the bottom, and up we go. And they never get back in because they don't want to be stupid and buy it on the way up. And pretty soon you've been hiding in cash while the market triples. People make this mistake all the time. So easy to do. You don't need to beat yourself up for it. But the way to avoid it is to buy index funds, diversify, and just not try to time the market. So going back to your question about AI. Individuals can't invest in OpenAI or any of these other companies. Venture capitalists are doing that. You do have some exposure to AI because of the whole economy. I just think, again, the way to do that is your S&P 500 index fund. Again, you want to rebalance. The market has been on a vertical moonshot in 2025. At some point, there's going to be a nasty pullback. But you are, if you own an S&P 500 fund, certainly if you own some NVIDIA or some of the other companies out there, you're exposed to AI. You're not betting the farm on it, but you're betting on it. And ultimately, hopefully AI will go on to be big and you will do well as a diversified investor. So very boring. I pitched this to a magazine editor a couple of years after I wrote the book and so forth. He's like, really? Like, can't you just tell us how to pick pick the next Amazon? Like, that's kind of boring. Like, we all know about index funds. It's like, yeah, I know we all know, and I know it's boring, but it's also the smartest way to do it.
Second to last one, what makes New York City unique as a ecosystem? If you're going to start a company, what makes New York City a unique place to start a company?
Focusing on tech companies, for example, one of the things that Kevin and Dwight and I talked about a lot in the mid 2000s when we started SAI that became Business Insider was the fact that what Silicon Valley had that Silicon Alley, New York, and other cities did not have is that they had several generations of tech entrepreneurs who had grown up in this idea that starting companies and raising capital and building them quickly, it's really exciting. Sure, a lot of them fail, but that's okay. In New York, it was shame to fail. You could never go to an investment bank and said you started a tech company and it failed. You got to hide the fact that you failed. And, it's a shame thing. Silicon Valley, they're used to failure. They don't love it, but it's okay. You failed. Maybe you learned something. The whole idea is speculative capital and going forward. And all of your friends have worked for companies that have soared, and then some of them have crashed, and a lot of them have gotten rich and they haven't. So you need that as a sort of like petri dish in which to create companies. And New York didn't really have that until that era. And what happened in particular was companies like DoubleClick, which had been a big New York 1990s company, went through a tough time. It sent lots of folks out into the world like Kevin, Ryan, and Dwight Merriman and many others who had been through it. They'd seen it. They knew how to do it. They knew how to raise capital, how to have an idea, how to start a team, how to structure the company and the equity. They knew that, hey, if you have a portfolio of 10 of these, 8 of them are probably going to fail or do poorly, but maybe we get 1 or 2 right. That's good, like ultimately. And so that generation, the second generation, really started to seed New York. And folks like Jason Calacanis with Silicon Valley Reporter had put it on the map. We'd had big, exciting 1990s, but it's that second generation that really take hold. They know how to do it. And now we're starting to have a lot more companies in a much wider array of sectors, including deep tech companies that like Mongo that Kevin and Dwight and a couple of other folks started. We just didn't have those companies before. And now all of those companies are huge and they are now sending their alums out into the world and those folks are starting companies. And so you really now have this big ecosystem of venture capital and experienced entrepreneurs and startup culture people who know what they're doing and know how to ride the cycles and are excited to do it. And that we're seeing that in a lot of places all over the world.
Very final question. You recently launched Regenerator. You've been podcasting. What is it that you're excited about right now, and or where do you want us to find what you're working on right now?
Well, Regenerator you can find on Substack or search Google, it'll come up. The podcast is called Solutions, and you can find that anywhere you get your podcasts. The theory of that one, by the way, or the thesis of that one is, boy, are there a lot of problems in the world. We know that. Sometimes we don't actually just want to sit and marinate in them all day about how much worse everything's getting. But most of these problems have solutions. Let's talk about what the solutions are. And so far, I do hear from people that's been well received, at least that framing. So hopefully people like that. And I'm also doing some other writing. In fact, I'm for the first time in 30 years, I was writing a novel 1,000 years ago after that Japan book and didn't have the wherewithal to really go after it, wanted to go into business and so forth. But I'm back to that. And I'm writing some novels now about AI and tech billionaires trying to take over the world and that kind of thing. So they feel very true to life and they feel very much taking advantage of a world I know pretty well. And that's been fun too. And so somewhere in here in the next year or two, I'll settle into one thing, but it's been very exciting to be able to put a lot of irons in the fire and do a lot of different things and see what I want to do at this stage of life, which is quite different than I was the first time around in the internet.